Demand for stuff, real things like hard assets, tangible commodities, and the companies that mine, manufacture, and deliver them is about to blow sky high for a fascinating reason.
The physical structure is too small. I mean, we have been so successful in online and digitalization that that the underinvestment is really becoming the monster in the room from everybody. So you can have the best platform in the world, but what's the point, Adam, if you can't actually get the last mile delivery in? And that is exactly what people are facing right now.
Welcome to Peak Prosperity. This is Peak Prosperity co-founder Adam Taggart, here for yet again another week of trying to make sense of these markets. This week, we're being joined by a guest expert all the way from Copenhagen in Europe. It's Steen Jakobsen. Steen, thanks so much for joining us today, Steen.
Thanks for having me, Adam. It's always a pleasure to be with you and Chris. So again, I really enjoyed it. Thank you.
Thanks. Always a pleasure to have you. And for those not familiar with Steen, Steen is Chief Economist and Chief Investment Officer of Saxo Bank, which manages billions of dollars in client assets. Steen often appears on CNBC, Bloomberg News. His commentary and analysis is in high demand by all the major financial news channels. Steen, let's get started here just sort of with the obvious. The global economy is still reeling from the impact of the coronavirus. Tens of millions of households just in the US alone are still out of work. Millions of small businesses are closing, probably in many cases for good. And there is no light at the end of the tunnel yet from the public health front. Yet financial asset prices are at all-time highs, some by a long shot. What's your general assessment of what's driving the markets right now?
The fact that it doesn't really matter what happens negatively or positively to the economy right now. We know what the response function is going to be. So let's take the worst case. The worst case, I think, is defined by what the central bankers from Powell to Lagarde is defining as this, gap in the actual demand of the economy. But overall, they have an extremely negative outlook, and they remain very cautious because they want to support the economy through fiscal and monetary easing and this duration talk that is incoming in the December Fed meeting about extending the duration, which is really another word for yield curve control, which they're getting afraid of. So what the market is doing is saying, listen, there's a lot of noise in the short term. It is fundamentally, practically a very negative story, but we're looking through that and I think that's the positive thing we have to take away from 2020. I mean, medicine, healthcare, and science has really stepped up. I mean, 1 year after the actual first cases being published in China 1 year ago, we're already looking through this week implementing actually vaccine being rolled out. So I think it's kind of impressive itself. And the market takes it in stride and saying, listen, if things go worse, we will get more stimulus. If things gets better, there's a pent up demand and there is an extension of the trend. But I think, if I may, Adam, I think the most interesting about the pandemic is that we sort of accelerated a decade into 1 year. We saw that things that we didn't even want to discuss before, universal basic income, MMT, fiscal spend to the size of which we have it today. And you may know I'm the founder and originator of what is called the outrageous predictions. And literally, we had a big issue being, outrageous relative to reality. What are we supposed to do? So say that Federal Reserve balance sheet will be up 150% next year because it was up 80% this year. So it's just, it's a free for all. I had a client this morning on a call calling it the Labrador economy, meaning that whatever happens, the Labrador is happy. And I think that is exactly what goes on.
Okay, it's a good analogy. It's funny with your outrageous predictions club. It's almost as if 2020 said, "You think that's outrageous? Here, hold my beer for a second."
Yeah, exactly. It's just mind blowing. And I think when we look back in history, 2020 will be remembered for a lot of negative things. From what I take away from 2020 is that we launched the stability paradigm and we moved into the social stability paradigm, which I think sets up probably one of the most interesting 2021 in terms of macro.
Well, let's talk about that, because that was actually my next question. I've been reading your recent work that you've been putting out, and you do talk about this paradigm shift of several decades worth of focus on financial stability, which I'm going to let you expound on this, but where we basically saw monetary policy really drive the picture, and the rich and wealthy were getting a larger and larger share of the pie. Now, and you tell me whether it's triggered by the pandemic or if this was going to happen anyways, but we're now shifting, as you say, into an era of social stability being the primary axis that things are going to revolve around. And there's a lot of new implications that come with that. So can you elaborate on that?
Yeah, very happy to, because I think it's a great setup. I mean, you can, and as you probably will, wholeheartedly disagree with me, but at least you have a framework to understand how we got here and how we move on. So I think year zero for financial markets is 1998, when Chairman Greenspan decided to bail out LTCM. I think that's the moral hazard that we live underneath today. That is the burden of which we operate under. So of course, every single incident, every single bump in the road we've seen since 98 has been dealt with a policy response which has catered to financial stability. Financial stability works as excess return for capital over excess return to deployment of land and deployment of labor. So effectively, the strategy was always and meant to be someone where you have the trickle down effect. You had the champagne glasses flowing over, which defines inequality. I think it is a scientific sin that the central banks continue to get away with saying that what the monetary policy they conducted has reduced inequality. I don't know what planet you're from if you could come up with that sort of academic paper, which both the Fed and ECB are producing in dozens right now. But the financial stability was about capital return, a return on capital being the driver. So what I'm saying, and what I think has been, and I think it would have happened inevitably, but I think it came fast because of the pandemic. So what has changed is that, and you can see that in the rhetoric, even from a guy like Trump, but overall from all the politicians, that social stability has become the number one concern. It is about making sure that lives are safe, that we operate in a way which is to the utility of society, that we strategically, organization-wise, operate under sort of constraints. And I think there are three drivers on social stability: inequality, which I think is clear for everyone to understand. And the second one is far more dynamic, because that changes the mix-up of fiscal spend versus monetary policy, and that is green transformation. So as I sit in front of you here, Adam, we are expecting a Biden green agenda. We have an EU budget which today or tomorrow will be agreed upon, and that is budget itself is called the Green Budget of Europe for the next 6 years. And on top of that, we have just seen China operate a new model called China 2060, which is to be carbon neutral by 2060. All of this means that companies, governments, and individuals spend and be incentivized to spend a huge amount of money to reinvent the logistic, the capital structure, the infrastructure of everything. So, and it comes with a massive tailwind. We've had this green transformation theme in our portfolio since Q1, and it has massively outperformed. And then on top of that, we have infrastructure. I mean, I'm saying this with a smile on my face, but going to an airport in New York or going to through an airport in southern the US is like being to a third world country. I mean, you guys really seriously need to ramp up and there's reason for that. The federal states, the division between state and government, but the fact is infrastructure is just so far behind. So what we're saying is this: financial stability has replaced by social stability three components: social inequality that transfer money directly to the pocket of consumers. And I think the most outstanding chart that I've seen this year is the fact that 13 million people lost their job in the US. At the very same time, they had the highest increase in disposable income ever in history in the US. And that tells you what has changed and what is different from the 08, 09 crisis. And that is that this time, not only do we do the financial stability, but we also add the social stability, which means that we transfer purchasing power into the hands of the consumers. And let me say, and it leads me to the second point. So if you look at the S&P 500 today, it's 80% immaterial value. So it's IP and people. So only 20% of the stock market today is in logistic and physical structures.
And the rest is in cat videos, right?
Yeah, on YouTube. But what is interesting is that the pandemic forced us to be digital. It forced us to be online. The stories and the companies operating a last mile operation for the online platform became extremely profitable. But as we talk today, we have the highest ever freight rate on container ships from China to the US. We have the highest ever freight rate between China and Europe. And in Europe, you cannot even get a container to deliver goods because the ramp up demand, the fact that we transfer money from the state directly into the pocket of the consumer has created so much demand on the system that the physical structure of our economy is breaking down. We estimate that the final mile cost right now of delivering goods is up 50%. You've probably seen the headlines that UPS and FedEx can't even get vans. They can't even lease vans to deliver. I mean, God, we better get these drones in pretty soon. Otherwise, we're going to be having, a lot of people being unhappy and not getting the packages. So the last mile, the long haul is exploded. And what we've seen since the election result was known is that the mining sector, which has been underinvested to, and I know you and Chris has been on this case for a very long time. So we have underinvestment, we have malinvestment in logistic and infrastructure as airports and final roads and final mile and vans and vehicles. We want to transform the world into an electric vehicle environment, but can you actually get access to the electricity? Can you charge your car? Can the grid take all of the pressure? Your grids in the US is not able to do that, according to the CEO of the biggest grid in the US. And similarly, can the rest of the world. As we talk, 28% of all electricity is generated by renewable. We're never going to get to 70 with the present technology. We need fusion energy or something else. But the main point, and I will give your viewers, is that one, social stability is different because it spends and puts money into the pocket of the consumer, and then it's supported by governments and companies who want to be ESG compliant, who want to be green compliant. But the biggest story is that, if you accept that digitization and online is going to drive everything, that the platform is still going to dominate, then they have a constraint in the physical road infrastructure, electricity delivery, the grid system, the production of electricity in terms of innovation in iPhones and others. And that is really creating what I de facto say, right now we already have inflation. It will not be measured by the capital market because the capital market has no price discovery. So the big conclusion, financial stability to social stability. Social stability means three new vectors that is operating as an impulse: inequality, transfer money directly, indirect transfer, and government support in social, in green transformation and in infrastructure. And on top of that, you have the fact that we have, misinvestment and capital structure too small for the actual online world of today.
All right, well, that is super fascinating, Steen. And what I take away from that is tangible things are going to become a lot more sought after in the next couple of decades than the demand we've seen over the past couple of decades. We've seen the digitization, we've seen the drive to online. You mentioned that 80% of the value of the S&P is sort of in intangibles now. That's been the dominant trend of the past couple of decades. But that digital world doesn't exist independent of the real world. It needs logistic systems, shipping companies. It needs products to be mined that can then be bought online and then shipped somewhere. And what you're saying makes total sense to me, which is we're going to see sort of given everything you mentioned, an explosion of demand for both infrastructure spending, which requires, ore and, other raw commodities to make happen, and then the things that those get fabricated into. So I think that's a really big aha coming out of this, which is like, hey, invest in commodities, invest in mining companies, invest in things that benefit from infrastructure spending and whatnot going forward. I see you nodding, so that's good. And then secondly, I think I hear you saying too, because it's sort of the social stability access is going to be really important. You're going to see more, direct money to individuals, to households. It's not just going to be trickle down so much anymore. And that sounds sort of like MMT and stuff like that. But I assume coming along with all the spending we're talking about, that direct to household stimulus, if you will, that is going to be much more inflationary than what we've seen to date, because that's going to unleash a lot more velocity, a lot more monetary velocity. Is that true as well?
That is true, and it's not true in the sense that, and that was my final point on the price discovery. My premise is that the financial market has no price discovery. I think every single price that trades in the market is a function, a derivative of government policy through regulation or through direct impact from central banks. So bond market has no will of its own. I mean, de facto, people talk about Fed may do extension of maturity, and that de facto becomes YCC, yield curve control, but it's already in place. They're already controlling. Every time we get close to 1% in 10 years, all of a sudden it comes down 5 basis point, right? So it's already a YCC. But what I'm saying really is that if you look and you use the old model of 5-year forwards as an indication of inflation, or even using the tips, you're not going to see it. Why? Because if you have a premise which is that there are no price discovery in the market, you cannot use prices that are extracted from the financial market as an indication of inflation. What I can tell you is that I have a number of shipping companies I advise. I sit on the board of a shipping company. I talk to business people who cannot get containers in the steel industry. I talk to people as you probably know, Maersk, a Danish company. It's a big container airline, a container company in the world. They can't get the physical containers in place. They can't do it because of the China deal. The demand from Christmas in the US too big. So what I'm really saying is that, and it's not even a play about value over growth. What I'm really saying is, as you just rightly alluded to, the physical structure is too small. I mean, we have been so successful in online and digitalization that that the underinvestment is really becoming the monster in the room from everybody. So you can have the best platform in the world, but what's the point, Adam, if you can't actually get the last mile delivery in? And that is exactly what people are facing right now. So the marginal cost of being a platform, and I think roughly we have estimated that 10% of all cost is transportation. The transportation up roughly 50% right now. So 10% of 50 is a 5% erosion of margin. But if you look at which is interesting, look at UPS forward guidance on margin. That is up 5 basis points. So what is going to win, as you rightly say, is like logistic companies. It's actually good old companies that have a fleet of vans that can deliver to the final mile, because the final mile is the most important part, which gets the package in front of the customer. But owning the platform anymore, I think has for two reasons has a marginal lower utility. One, because they are facing structure from the physical world, and secondly, because the platforms have the highest risk sensitivity of all businesses in the world right now. And that's because the way the reason why we love the technology companies, that people say, my equity analyst tells me all the time, but listen, Steen, Amazon have a predictable cash flow for the next 100 years, and I discounted zero interest rating means it could go to infinity and beyond. And I go, that's right. But the problem is that the one risk you have is high interest rates. And if you accept my premise that there are physical constraints in the world, then inflation will come through the physical lack of investment, physical lack of delivery on logistic and infrastructure overall. So the central bank can have all the intention in the world to let the inflation run loose, but it's going to run too fast. So my two takes for 21, as we sit here, is that one, we'll get higher growth simply because of the pent-up demand and because the rollout of the vaccine will be faster than expected. And secondly, the physical structure deficiencies is going to be a huge cost for society, for the online platforms. We'll just get inflation to 4 or 5% next year.
Okay. Well,
but not the measured inflation, because the measured inflation is really rental value in the US. The CPI in the US is rental value. And interesting enough, because of the work from home status, rental prices in San Francisco is down 20%. So right, the CPI in the US, right. The CPI in the US can go down 20%. Meanwhile, everybody who's productive in society in the US, the online businesses are facing cost pressures equivalent of 5% on the margins that is coming down because simply they are too successful. So I love that quote. The digitization and online platform have become too successful, so much that they have exceeded the capacity of the physical structure to deliver to their success.
Yeah, that's super well put. All right, so Steen, demand for real things going to be, very robust going forward from your perspective. If I hear you correctly as well, the price discovery in the market's broken, but I can also sort of interpret that as to the market hasn't quite woken up to this yet as well. And so I think there's sort of a dual opportunity here, right? There's just the growth of these companies based on the demand, these physical, tangible, hard asset, real world type companies. And then there's sort of the optionality that at some point the market's really going to wake up to the fact that it's currently undervaluing them given the current dynamic. So for investors that are watching this is really important, Steen, because we have a lot of people watching this who have been very skeptical of the markets for a long time, given the high levels of overvaluation that they're at. And there's still a bunch of people that I think are sitting in cash, wishing they could be invested in something, but are worried about a market correction, happening beforehand. We have long said, okay, look, be defensive. We have recommended that people over time build exposure to hard assets. Everything you've said just lent a whole bunch of tailwind to what we've been saying. For those types of investors, how would you recommend they sort of consider playing this? So you talked about, logistics companies. I'm sure mining companies are probably pretty good to look at, maybe owning some commodities directly. Are there other opportunities you would encourage them to look at? And B, what is your concern about maybe a short-term market correction, to position for before going really long on this trend?
I think the best I can do to offer insight into that, to say how my portfolio look like and how I've constructed it to be able to withstand the next 2 years. So one, I am, as always, with you and Chris on that, I'm nervous about the correction, but I realized that, the best way to look into the future in terms of investment is to create a portfolio that can withstand, a 100-year crisis or the next decade. So what I've done, and in loose terms, is that I have about 30 to 35% in equity. What I'm of course doing is transferring from the platforms to the logistic companies in terms of that. They're in the same space, but they're in different opposite side of the coin, so to speak. I am investing into China. I think the digital currency in China that is being implemented in 21 is going to be a huge sea change, because if you have a digital currency, you really can open the capital account and control the capital outflow from domestic audience. So China is underweighted globally. So I have a little bit of China in the equity portfolio. I have the mines, as you indicate. I have the green transformation. I have the logistic as a component. So I have moved to sort of hard ashes, the physical world versus the technology, but still playing on the technology, because the UPS and FedEx will do extremely well if the platforms do well. And then comes what I want to add is that, so I have 5% exposure to long volatility at all times. You can do that through an ETF. And why do I have 5% exposure to ETFs, which most people know over time will lose me my money? Because investment over time is about having multiple assets that has inverse correlation to each other. The only asset that withstood the downdraft that we saw in February and March was long volatility. Volatility was up 400% in February and March. So imagine you have 5% volatility, same scenario, the market totally correlates to one, everything goes down, bonds and gold and equity at the same time. Then you have 5% at 400% is 20%. I mean, I think I would have been very, very happy to have 20% return in a small bucket of 5% in volatility. Yes, I would still have lost, 30, 35 at the worst time, but that would have given me the ability to navigate and trade. So 5% in volatility, which you can buy through some beautiful, easy midterm, and it's very important if anyone wants to do anything, and this is not advice, you look for the midterm ETFs, not the short end, but the midterm structure of the ETFs. And secondly, I have inflation hedge. So the best, which fixed income product is the best performing asset in the US this year?
No, you don't
Inflation.
tell me.
TIPS. TIPS has outperformed 10 years and 30 years this year. So, TIPS is just, the market right now is pricing minus 92, 99 basis points of price. The good thing about TIPS is that there are no zero bound. So theoretically you have, according to Fed, a zero bound, as zero interest rate is the maximum you go to in 10 year. But when you play TIPS, you can have minus 400 negative real rate. So TIPS has been a phenomenal, has long duration. So I have TIPS for 10%. I have gold for 20%. And then, and you're probably going to be surprised considering my lack of hair and my old age. Then I, like everybody else, has bought into the concept that Druckenmiller called the West Coast money. So I have right now 9% between Ethereum and Bitcoins, because simply I think 21 would be the year where we make a breakthrough in terms of blockchain. Blockchain sits best right now, as I see it, on Ethereum, and Ethereum for me is the silver of the new generation, and I think Bitcoin is the gold. And I say something with a smile now, Adam, because you're going to be including this. I've promised myself to understand the world in 21. I will not read a single research paper by anyone who's older than 40 years old. I mean, if I look at all of the, and I'm not going to not going to be negative about anyone who's famous out there, but let me say this: there's not a single famous person in our area I want to listen to who's over 40 years old. There's a whole new generation of people, the West Coast money, the people who grew up in Silicon Valley, people, the young people who wants to be on platform, who want to be in the shared economy, who want to have a green transformation idea. Those are the one who's going to inspire me for my picks in terms of what I want to do for the coming years. Because you and I, Adam, we are way past the last sell date. And when I read the research from sell side right now, I'm shocked at how complacent they are about this paradigm shift that we're seeing in the world. But that's sort of my combination that, to round it off, you need to exposure to the long end, which is 30-35. But like you and Chris, I don't really want it in the over expensive side. I want, oil and gas is only 2% of the S&P 500. I mean, the 5 biggest FANGs is 28%. I'd rather own the oil than I own the technology companies for the short term. But long term, I want to own the infrastructure, the tangible assets, the underinvested mines, the underinvested green technology transformation. And then I'm buying insurance policies in terms of tips, insurance policies in terms of volatility longs, and then gold and a little bit of crypto. And that's just an optionality. If I'm wrong, I'm going to lose 9%. If I'm right, I'm going to make whatever, 20-30% on that.
Steen, that was just an excellent recounting of how you built your portfolio and why, and that's exactly the kind of insight that people watch these videos. So thank you so much for being so detailed and going through that. And I will say, your portfolio strategy makes an awful lot of sense to me. Folks are wondering where peak prosperity is in terms of an allocation like Steen's. We think that there's an awful lot of compelling logic behind it. All right, Steen, I've taken up way too much of your time. You've stayed late because you're over there in Copenhagen in Europe to talk to me. Thank you for doing that. It's always a huge pleasure to talk to you. I hope we can have you on in 2021 to see how some of your outrageous predictions from the end of this year come true. But my instincts tell me that you're going to have a very strong 2021 with that portfolio positioning.
And I look forward to meeting you in person again over in the US instead of all this nonsense with Zoom and YouTube or whatever. I'm fed up with it. I'm too old for this crap. So best wishes to everyone, and see you very, very soon on the other side of the calendar year.
All right, Steen, thank you. All right, and as we do every week, we're going to debrief what the markets have done over the past week since last week's market video with the lead partners of New Harbor Financial. That's the financial advisory firm officially endorsed by Peak Prosperity, and I'm joined here as usual by lead partners John Lodra and Mike Preston. Hey, John. Hey, Mike. How you guys doing?
Hi, Adam. How you doing? Good to see you again.
Nice to see you, Adam.
Good. And guys, great discussion there with Steen. I know you guys were watching it. So really, I'd like to get a sense of your guys' reaction to what Steen said, both in terms at the macro level, this big shift from, multi-decade paradigm focused on financial stability, shifting to social stability. But in terms of sort of the opportunity in the markets may now be shifting from all the platform companies, which have really been the dominant story over the past couple of decades, and now shifting back to real things. The companies that deal with digging things out of the ground, building things with it, and then transporting it. And maybe once we get your initial feedback, we can talk about. Steen actually was generous enough to give kind of a real peek into the allocation of his current portfolio. I'd love to hear what you guys think about that too. John, why don't we start with you?
Yeah, no, I think the thematics that Steen talked about there really resonate with us, and big picture kind of take that that's consistent with our take on kind of the trend away from kind of these big platform tech companies that are a whole lot of intellectual property and social connection at the expense of real life experience and things and movement of goods and services. So I think there's a pendulum that will likely swing in that direction. It should be noted that resource stocks, the material stocks that go into these things, are at pretty, historically low valuations relative to the broad market. So there's a value play there that is nicely consistent with that thematic trend. There certainly is no slam dunk though. I mean, one of the drivers of that shift, and I think Steen spoke to this, was infrastructure spending and government-led programs at a time where government finances, particularly at the municipal and state level, are really challenged. They've lost tax revenue, in no small part because of the pandemic and what that's done to everything from sales taxes to occupancy taxes and whatnot. But big picture trend, we think that's a very likely scenario, and the thematics really resonate with our leaning towards tangible things and real things, both in their form, but also because their valuations are relatively more attractive.
All right, and John, to your point about on a relative basis, the value of companies that work in the tangible world being at sort of I'm going to say historic lows. I just want to show this chart. We've shown a variant of it before, but this shows the commodity index versus the S&P 500 ratio. And you'll see here it goes back over the past 50 years. And honestly, the ratio has never been lower in the past 50 years than it is right now. And you see this version of the chart where it's circled there at 2020 shows the current ratio value of 0.48. And that compares to a median price over the past 50 years of 4.1. So we are like, basically an order of magnitude below the median price. And then you see this little dotted line going up to the median that's been drawn here on the chart. This wasn't done by Steen, but looks like it could have been. Steen is basically saying, look, at a minimum, we may actually have a reversion to that median there. And that reversion alone would be a 10x gain. And then of course, Steen made a really compelling argument for all sorts of other reasons why we might see it extend way beyond the median because I think he made a good case that there's a lot of demand, a lot of pent up demand for that. Mike, I guess before we continue further, do you have anything that you want to add on to John's reaction to Steen's commentary?
Well, I really enjoyed Steen's commentary. I liked how he said the zero bound for the market, and when bailout started was 1998, long-term capital management. And one might argue that it was actually the response to the Black Monday, which I think was October 19th, 1987. Alan Greenspan was just a month new to the job, and his reaction was basically liquidity and bailouts. So it was 1987. Maybe like Steen says, 1998 is a better starting point, but it's been nothing but constant liquidity and bailouts since then. And we agree with him that that's created this giant bubble, certainly post 2008, companies that, were intangible or sold ideas have benefited mightily from the financial engineering. He said in his talk that 80% of the S&P is intangibles, which just blew my mind. I didn't even realize that. That's a huge number. And if you look at value stocks, like coming full circle and talking about companies that make things, like oil and gas, a sector that we like, that we're looking for a pullback to potentially add to our portfolio. And shipping companies and logistics companies, those are all value plays. And going on 11 years now, value has just been really underperforming growth or the idea type tech. And it's one of the longest cycles on record of underperformance. These things don't usually last that long. And, the last time I can remember seeing that was when the value managers threw in the towel in 1999. And that was the beginning of a multi-year period of time where value stocks outperform. So we agree with Steen that we want to be looking at sectors that make real things, tangibles. Energy is 2.4% of the S&P, still near an all-time low. And, so we're definitely scouring for opportunity. The truth is this market's been straight vertical, from the March 23rd low. It's given very, very small opportunities for entry. And the S&P is, and the broad market is showing a lot of euphoric signs. I mean, basically checking every box times 100. So the very first pullback in the S&P will probably give us a chance to add a little bit of exposure there. So I don't know if that answered your question. I think I'll take a pause there for a minute.
Okay. Well, it did, and I'm going to maybe re-ask the question just slightly differently and give you a chance to react. Steen dialed through a number of different elements that his portfolio is currently invested in, given the type of future he sees coming. And I'm not saying you guys see the future exactly the same way Steen does, but knowing you guys, it seems to me like you're similarly minded, let's put it that way. So he talked about, logistics companies, miners, green infrastructure build out companies or companies that'll benefit from that. Companies that are in the commodities and companies that either mine or transport those commodities. He talked a bit about crypto exposure. It definitely seems like that's becoming a real part of institutional portfolios now. And then he talked about having some inflation protection, which he was doing through tips, and then also just having some general portfolio insurance, which he was doing by buying long volatility. I know you guys do an awful lot of portfolio protection as well, not necessarily with long volatility plays, but with protected puts and things like that, straddles, et cetera. But the question is I know you guys are heavily into cash right now. It seems to me what you just said, though, Mike, is that you're sort of waiting for better valuations to deploy that cash into a lot of the same areas that Steen provided in that list I just dialed through. Is that a generally accurate statement?
Generally accurate. I mean, certainly we're more conservatively postured than Steen's portfolio. I mean, for instance, he talked about 20% gold. Our managed portfolio is 10% or so. It varies from account to account, but the target's 10 to maybe 15% with some recent appreciation of gold mining stocks. We're also advocating for people to have 10 or 15% of physical bullion, but that's outside of our portfolio. Generally, we're advocating that they have that or purchase that and store it where they can get their hands on it. So our allocation is pretty close to about the same between miners and bullion in terms of what we recommend. It's about 20 to 25%. We're interested in the crypto space. We're in the middle of investigating it. We really haven't done anything there. Long volatility, that's interesting. I think that's really interesting what he talked about, and that you get a home run eventually that makes up for all the losses in the interim. What we're doing with puts, protected puts, isn't much different. When you're buying a put, you're long volatility, in general. When markets go down, volatility explodes and the value of puts go up. You might argue that volatility is more of a pure play on volatility, but I think we're just coming at it from a slightly different angle. But big picture, the thing that I would want our clients and prospective clients to know is that we're open-minded about adding more exposure. It's been a very, very one-way street in this market. Very few opportunities to enter. And at the same time, there's this whole FOMO, fear of missing out, going on, that as investors and managers, you have to be careful not to get sucked into the whirlwind. You don't want to be stubborn and wait too long. But at the same time, it's a pretty historic time that we're seeing here with this money printing and the absolute FOMO and the levels of euphoria and bullish sentiment that's off the charts. I mean, the 5-day put call ratio just hit an all-time low the day before yesterday. There's been an insane amount of call buying, mostly by retail traders. We can go on and on. So yeah, we're definitely looking to get more constructive, particularly in value type stocks. And I think that we're actually not too far off of what Steen had described there.
Okay, great. And John, I know that there's a chart you sent over that I want to let you talk about in just a second, but on this topic of risk protection, because it's such an important reason, why we've created this partnership with New Harbor over the years. And it's such a huge part of the value proposition that you offer to your customers. So many of the people who come to us and are looking for a good advisor to work with, by far the attribute that they're looking for in a good financial advisor, besides trustworthiness, obviously, is somebody who can help focus on capital preservation. People, first and foremost, don't want to lose the wealth that they've worked hard to save up. And we really like and appreciate the expertise that New Harbor has in buying insurance into the portfolio to protect from downside risk. And relatively recently, the gold price dropped pretty substantially, and the mining complex obviously dropped even more than the gold complex did. And it was a really good, just continued example of how the protections you put in the portfolio protected your mining position. Can you just talk about that for a second?
Yeah, absolutely. And just to keep it real simple for folks who aren't familiar with options and put options and the terminology, it's just like an insurance policy. Just like you buy insurance on your home or your auto, you want protection to protect an asset, in this case, an investment. And like with most insurance, you pay a little premium, insurance premium in return for that catastrophic loss protection. That's what put options are. So yeah, we had and still have, frankly, put options in place on our gold mining sector for those accounts that are large enough in our client list that we can use options. Below a certain level, it becomes a little challenging for us to use options, but for a broad swath of our clients, we use these put options on the gold mining stocks. And what happened in the November expiration date of our options, the gold miners actually went below our insurance levels, which means the insurance kicked in. So we were able to, basically exercise that insurance and save some of the downside that otherwise would have accrued to client accounts. And I guess even better, we were able to buy back into the gold mining stocks the very next trading day, which happened to be a Monday because it was right before weekend, at a little bit lower than where we sold it. So it was, a modest but important, I guess the point, like with insurance, is it's most important when you need it most. Had those gold miners dropped even further, that's where the insurance really would have been of tremendous value, like it was in March, for example, when gold miners sold off very abruptly with every other stock category during the COVID scare. Even though they shot back sharply, we had those put options in place back in March and took a huge amount of the downside off the table. So yeah, they did what they were supposed to do, and we're happy to have them when they make sense.
Great. And hey, I know you want to continue to talk about that chart, but real quick, I mean, I just want to remind folks, I remember in March when most investors' hair were on fire because they were watching their value of their portfolios, basically get whacked by a third in a very short period of time. There was a moment there when we had you on for this weekly video where your portfolio, the general market, like the S&P, was down like 33%. And the New Harbor portfolio, I think, was up 1%. And to your point of insurance, matters most when you need it, right? That, to me, that's just a great example. And you've had several, over the past decade when the markets have had an unexpected dip, where the value of that protection is all of a sudden incredibly self-evident when you get a relative performance differential like that. So sorry to interrupt, but I thought it was an important point to emphasize.
That's quite all right. Yeah, to the charts I sent you, really relevant, and they're actually from GMO, which is big. Boston-based institutional money manager. They do great research. They come out with quarterly newsletter every quarter, of course. Their most recent one just came out, and the title of that newsletter, it's a great read for anybody that's inclined, is what was it? Value: if not now, when? Basically, the title says it all. Value relative to other, say, like growth stocks is, the basic gist of the piece is that value is at historic lows relative to growth. And a couple of charts I sent you over. One shows the relative valuation of the cheapest value stocks, and there's two different charts. One for companies with high intangibles. So even value stocks, even if they have high intangibles, they're still good values relative to growth stocks. But even better values at the 0 percentile of historic, meaning they've never been this undervalued relative to growth stocks, for the low intangible companies, the physical asset, real stuff that, Steen talked about. So it's a really compelling chart that's really consistent with the theme or the message that Steen talked about. The second chart I emailed you basically just shows the price to sales ratio for growth stocks. And, the punchline is it's never been higher. This chart goes back to 1971, and it's, the picture says 1,000 words. It's higher than any time in the last, certainly 50 years or so, which covers a lot of ground.
Yeah, and you compare that too with things like the famous Buffett indicator. Again, that's at all-time highs as well. I mean, just so many of the standard valuation metrics for judging whether
market cap to GDP hit 1.8 today. It's just obscene. And Buffett was famous for saying that when it gets above 1, nearly half of what it is now, you got to be concerned. So that was a long time ago in terms of market valuations.
Yeah. So just a healthy reminder for folks that unless it truly is different this time, which it virtually never is in the world of investing, people say, well, look, when I start seeing signs of excess, then I'll start positioning for the door. I don't know what signs, what more kind of signs of excess you could get than the types that we're mentioning right here. All right, Mike, real quick as we wrap things up here, if you could just give us any of your thoughts on what's happened in the week since we last had you guys on. For my quick read, markets have seen like a little bit more volatility than they've seen previous, some up days, some down days. I don't know if they've really gone that far, but we're approaching end of the year. Let me know what you're seeing sort of through your lens at the markets.
Sure. I mean, one thing I was just noticing at the close of the market here is that Airbnb is out today, an IPO. We're seeing an absolute frenzy, here. This is a frenzy that is reminiscent of 1999, the types of money-losing IPOs that come out and then double on their debut. Airbnb more than doubled from an already, I think, multiple time raised offering price. It doubled in public trading to over $100 billion for a company that's solidly losing money and makes very, very razor thin margins, if at all, on bringing people takeout food to their door. It's pretty amazing to see,
Yeah. Hey, Mike, just to comment on that, our buddy Sven Henrik, who we've had on the program here previously, he had a great observation today. He said Wall Street just brought to IPO 2 companies today with a combined revenue of 5.8 billion, and investors are paying a combined market valuation of 169 billion for those 2 companies. Yeah,
Airbnb's one. DoorDash is the one that I mentioned, bringing the food door to door. It's pretty amazing. Pretty amazing. Shocking, frankly, but it is real right now. I think we're going to look back and be shocked by it. But, in the meantime, the bubble continues and only gets bigger. The Russell 2000 hits new highs. It's a whole bunch of companies in the Russell 2000. This is small and medium-sized companies aren't even making a profit. It's hard to calculate actually what the valuations are in that group because a lot of them aren't making profits. But, that whole index has gone vertical. Breaking down the numbers week to week, not a lot has actually happened. Different indices are hitting new highs on a daily basis. I think it was just yesterday maybe that the NASDAQ hit an all-time high, and maybe the day before in the S&P. But if you look at where we are right now versus where we were last Thursday evening when we recorded, we're flat. We're completely flat on the S&P. The 10-year Treasury is down about 5 basis points to 0.91%, or 91 basis points. Steen mentioned early on in your talk that he thinks that there's some control going on there, or there's some market forces beyond what one can explain. Because every time we're knocking on the door of 1% on the 10-year, it gets slammed back down to 0.9 or so. We're watching it closely. It's something that not a lot of people are talking about or looking at, and we wouldn't be surprised to see that bust through the 1% point pretty soon. And I know we say it every week, but volatility remains high. We're up at 22 on the VIX. We're just stubbornly there in the low 20s. Steen talked about how volatility can explode. Certainly in March it did. It went to 85 and within a week or two. So market is seeing some risk, a very good amount of risk, and we think rightfully so. And lastly, gold is pretty much flat. It was up the last couple of days, but then down yesterday. And so it's basically where it was. It's where it was. So it's just another holding pattern at the all-time highs. I can tell you we're having lots of conversations with people that have FOMO that want to be in. Whenever we have these multiple, many conversations about people that just know it doesn't feel quite right but want to be in, it's a huge warning sign. That's all I can say. We don't know when it's going to turn, but it's very concerning.
All right. Well, we'll leave it at that. But yeah, folks, we're going to continue. Whatever happens from here, we'll continue tracking it with our guest experts every week, and with John and Mike every single week. But as you're hearing from John and Mike here, we're just seeing excessive stretching and deformation of valuations, and at some point, you're not even going to be able to, close your eyes and believe the make-believe stories that are being told here, whether it's the DoorDashes and Airbnbs, whether it's the Russell 2000, which has almost doubled since March. And, I've mentioned this in several weeks past, but I mean, guys, I can kind of understand, not that I agree with, but I can understand the story, driving some of these mega fantasy high-tech companies. but small to medium-sized companies, which is what the Russell is made up of, those are the companies that are dying right now, like literally going out of business, laying off workers and whatnot. And why so much capital is rotating into that space right now is a massive head scratcher for me. And to me personally, a clear sign of that we're in the later innings of this current run up. All right, well, with that being said, guys, look forward to seeing you next week. Real quick, folks, a couple things. First off, we just released a video with Ron Paul on the Peak Prosperity channel, which kind of dovetails with a lot of the comments that were made in this video. So if you still have the stamina for another interview, that was a fantastic discussion. Go to Peak Prosperity. You can find it there. You can find it on our YouTube channel. If you haven't yet, please subscribe to this YouTube channel. That way, every time we launch a new video, you'll get alerted of it. And it's really one of the primary ways in which we get the word out about the content we're generating here at Peak Prosperity. If you want to know who's going to be our guests on future market update videos and the other podcast interviews we do, follow me at Twitter at @MenloBear. I also love to hear your suggestions on who you'd like to see as a future guest. And then lastly, if you've been inspired by the expertise here, the discussion, Steen, Mike, John, et cetera, and you're looking to talk to a financial advisor who understands the risks and the macro opportunities that we've been talking about here, if you can't find a good one on your own, we highly recommend reaching out to the folks at New Harbor Financial. Talk to John and Mike and their team. We've arranged a completely free, absolutely no commitment, no obligation, free consultation for anybody who watches these videos. If you're interested in learning more about it, it takes just seconds to sign up for it, and all the details are provided here at the end of the video. All right, with that said, John and Mike, thanks again for another great week of analysis, and I look forward to seeing you guys next week.
Thanks, Sounds great, Adam. Thanks a lot.
If you'd like to schedule a consultation with the financial advisors at New Harbor Financial, simply go to greylockpeak.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given the latest market outlook. They're willing to do this because they care about protecting people's wealth and because Peak Prosperity has connected them with so many thoughtful investors just like you over the past decade. Chris and I started doing this because so many people have approached us in frustration and are looking for a solution because they're feeling out of alignment or just downright ridiculed by the standard sort of financial advisors who have been managing their money. You know the type, the kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, don't worry, the market's always going to take care of you. For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing, which is why we strongly believe that today's investors are best served working in partnership with a conscientious professional advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, just as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you aren't, or you're having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. And for those about to ask, yes, there's a business relationship between Peak Prosperity and New Harbor, which we had to put in place to make sure that everything is handled according to SEC regulations. All the details on this are clearly provided on the greylockpeak.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to greylockpeak.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.